In this section, we are learning the disposition of accounts or notes receivables. Receivables is asset have value, right? So the firm, if they have shortage of cash, and they probably use all their credit line from the bank. So to sell their assets in exchange for cash is another choice. Okay, and especially for some firms, they have a huge amount of receivables, right? So this happens, for example, the hospitals. We know hospitals, yeah, they have millions of accounts receivables. So if their customers or patient cannot make payment on time, the hospital usually sell their receivables to the collectors. Yeah, I have this experience because I traveled for 3 months and I received multiple mails from the hospital, but I didn't pay, right, because I was not here. And finally, I received a letter, the notice from the collector. Okay, not the hospital. Okay, now let's go back to this topic. So for the firm, the disposition of accounts on those receivable, there's two approaches. One is use the accounts receivable as collateral for borrowings, or just simply sells the receivables. First, the sales of receivables. Okay, so we know receivables is generated from trade in most cases. Okay, so it represents the relation between the customer and the company who is the seller. And when the customer places an order, the firm delivers the products, and if the customer did not make a payment, accounts receivable is generated. But some firms, they want to have the cash earlier, right? So they find a factor. So first, they request the credit review. Whether credit review is to check the collectability of these receivables. And then, if the factor approved, the factor will pay the cash, usually a discount of the original balance of receivable to the company. And then this will, the factor become what? The owner of the receivables. The next is the factor will contact the customer and request for the payments. Okay, so that's the relation. And for accounting, sales of receivables we classified into two different categories. One is sales with recourse. The other is sales without recourse. Okay. So what's their difference? Okay. The first one is sales with recourse. The purchaser assume the risk of collection. Who actually is a factor, right? And the seller records losses on the sales. Sales with recourse. Okay, the seller, the firm, guarantees the payments to the purchaser, who is a factor. Okay, so that's their difference. So we will see that with recourse, there are more protections to the purchaser. Okay, and the accounting treatment for these two categories are different. Let me use two examples to show you what's their difference. Read this question. So this is a category sales of receivables without recourse. Okay, so the amount of accounts receivable is $500,000. Keep in mind, this is sales of receivables. So when the Christ sells $500,000 of receivables to the factor, Chris will write off the accounts receivable by credit. Right? And based on their agreement, the commercial factor, usually a bank or any financial institutions, first charge 3%. That's a finance charge or a kind of fee, okay? And this will be recognized as a loss for the sellers of accounts receivable. And there is a 5% accounts receivable, the probable adjustment. What is? Yeah, we record it as the due from factors. For the sellers of receivable, this is an asset. Okay. Why here we created one more account? After this sales, for example, maybe the customer of Christ return some goods, right? So that will decrease the balance of accounts receivable, which will affect, the interest of the factor. This one is just a extra protection to the factor. So that's a probable adjustment. If that happens, for example, return of the goods, right, which will decrease accounts receivable balance, this will be a potential adjustment in the future. Then the total cash received by the Christ is the difference between 500,000 and 25 due from factor and loss. So the net worth is $460,000. So this is journal entry recorded by the firm. For the commercial factor, its journal entry is just matched the journal entry by the Christ. $400 will be received as an asset and pay cash to the firm and recognize interest revenue, which is a loss of the seller. And 25 again, this is a liability. Okay, so liability to the seller of the receivables. So this maybe will adjust. Okay, depends on the change of the future accounts receivable. So that is an example of without recourse. Now is recourse. Okay, so recourse is like let's go back to the PowerPoint. Recourse is the seller guaranteed payment to the purchaser. Okay, so this is like kind of insurance, right? Insurance for the purchaser. And if in this case, if the value of the recourse is $6,000, and we know that's actually an extra loss for the seller. In the prior example, we know the charge by the commercial factor is $15,000, which is 3% multiply $500,000. And now there is an extra. This is a charge to the Christ texture. So the total is 21. So this is also the total loss from the sales by Christ. Okay. And the journal entry is a little bit different from the one without recourse. Actually is the seller of the receivables recognize actual loss, which is the original 15 charge plus the value of the recourse. And it also recognizes the liability. This may become loss or not. Okay. And for the commercial factor, there is no change. Next is secured borrowings. Okay. Let me just use an example to discuss how to recognize this transaction. Okay. Please read this question. So Rashid firm assigned $400,000 accounts receivable. So this is the book value of accounts receivable as collateral for a loan, $200,000. You will find the loan is a lot of less than the book value of receivables. Yeah, this is not sale. This is just, a loan. Okay, using accounts receivable as collateral. There are two charges by a bank. One is beforehand charge 2% of accounts receivable. The other is because it is a loan, so it also charged interest. And this interest is annual interest rate. So first, the beforehand charge is 2% of book value of accounts receivable. Okay, keep in mind, book value of accounts receivable. So the first charge is the product of the rate multiplied the balance of accounts receivable, which is $80,000. So here, the contract was signed on April 1st, 2017, and the loan is due on July 1st. Oh, also here, right? So from April 1st to July 1st, April, May, June. So there are 3 months, right? During these 3 months, the bank is going to charge 3 months interest from Rashid. So the interest we can calculate, which is the principal of the loan. Okay, do not use $400,000. Okay, you use the balance of loan, multiply 10%. This is annual interest rate. 3 months is 1/4. Okay, this is $5,000. Right, $5,000 is the interest charged for the 3 months loan. So the journal entry is next page. First, on April 1st, the firm have a loan, so that's liability. But its net proceeds is less than the liability. Why? Because there is a charge in advance. Then the second is whenever the firm collect any amount of receivables. It's nothing to do with the bank because who is the owner of the receivables? Rashid company. Okay? So last one is when the loan is due. This is just like regular journal entry when any loan is due. So we write off the loan and recognize interest expense and pay the cash. Right, 205,000 represents the total principal of the loan plus interest. And in financial accounting, the secured borrowing and the sales of receivables, it's sometimes it's hard to tell what's their difference. Okay, especially from outsiders who knows how the two parties write their contract, right? Just like operating lease and capital lease. So we have the criteria. So if there is any transaction regarding the disposition of accounts receivable, if the transaction meets the standards, we will recognize as a sales of receivables. If not, it is recognized as secured borrowings because what? The journal entry of both are different. Okay, so here this is like a test. Okay, test whether the disposition is a sale or it is borrowing.